All right, let's get right to it. S&P 500 futures, they're hovering near flat at 6,920, just stalling out after Friday's record close.
Yeah.
When you look at the tape this morning, I mean, the immediate takeaway is just one word: thin.
So thin.
We are deep in that Santa Claus window, but institutional volume is vanishing, which means any small trade today is going to have a really outsized impact on the indices.
And it's a total data vacuum right now. We have no major economic releases that can really move the needle until, what, Wednesday's FOMC minutes?
Yes.
So the market is running purely on fumes, momentum fumes, and, required year-end rebalancing.
Right.
The only, I'd say, marginal tailwind we saw over the weekend was actually geopolitical. We got some fresh signals indicating accelerating Ukraine peace negotiations.
Which cooled off oil volatility a bit.
Exactly, and that provides at least a small lift for risk on assets.
Okay, so let's unpack the structural question here. The S&P is up 17% this year, nearly 80% over the last three. I mean, this isn't just a rally anymore, it's a structural bull market.
It is.
So the mission for this deep dive is to answer that core strategic question. Is this low-volume drift, this hovering around 6,920, is this the final gasp of the rally? Or is it just quiet consolidation before we finally smash through that psychological 7,000-point breakout?
And to figure that out, you have to look at where the money's moving this morning.
Let's do it.
We move directly into the pre-market action, and the action is it's centered on infrastructure. DigitalBridge, DBRG, is surging 35% on heavy pre-market volume.
Wow.
And this move isn't just noise, it's that institutional pivot we've been talking about for months.
Right, and to help you understand this shift, for the past year, the story has been pure play AI software, the gold miners, if you will. But now we are seeing serious money rotate into the physical layer, the data centers, the fiber networks, the actual digital infrastructure required to run AI at scale.
Exactly. DBRG's massive gap up reflects that intensifying institutional interest in physical capacity. Big money is prioritizing the picks and shovels right now because they see the immediate capacity constraint.
So they're trading, what, the uncertainty of future AI adoption for the certainty of current infrastructure demand.
That's the perfect way to put it. It's a risk-off rotation, but it's happening inside the AI sector.
But is that a temporary move? I mean, doesn't the sheer scale of the long-term AI market mean they'll just pile back into the pure-play software providers once the data center build-out catches up? Why abandon the gold miners entirely?
It's not abandonment, it's prioritization.
Yeah.
It's based on fiscal clarity. When you buy a physical asset like a data center, the revenue stream is clearer and the valuation ceiling is less susceptible to a high-yield environment, which we'll definitely come back to that point.
Okay.
Speaking of clarity, look at Coupang, CPNG. It's up 3% pre-market. This is deliberate strategic cleanup maneuver.
They are committing a full $1 billion to settle data breach claims. And they're doing it with customer vouchers. That's what we call weaponizing the balance sheet for a cleanup.
It's an expensive way to buy a clean slate. They're using their cash stockpile to remove a significant legal overhang ahead of 2026.
So future earnings calls won't be dominated by litigation risk.
Right, they've cleared the decks. For institutional investors trying to forecast next year's risk, that $1 billion payment is actually seen as a positive investment in predictability.
That's a strong strategic move. It contrasts pretty sharply with the headwinds hitting Sable Offshore, SOC, which is sliding 2%.
Oh, yeah.
Their problem is entirely external: regulatory gridlock.
Precisely. An emergency environmental injunction blocked their California pipeline restart. SOC's primary path to revenue, it was all dependent on production catalysts. This just reintroduces a completely unpredictable regulatory element.
And it stalls the entire thesis.
The whole thing. It just reminds you that when volume is this thin, these external unavoidable risks like regulation, they get amplified disproportionately. It hits the stock price immediately.
So that's the difference between a controllable legal cleanup and an unavoidable regulatory risk. Okay, before we define our tactical levels, we have to anchor ourselves to the structural headwind facing this market today.
We absolutely must. We are in the final lap of 2025. And yes, volume is thin, which can lead to some window dressing maneuvers.
Where fund managers are just sprucing up their portfolios for client reports.
Exactly. But the real anchor is the 10-year yield, the US 10Y. It's holding steady at 4.14%.
And this raises a really critical point about valuation. That 4.14% 10-year yield is no longer just a metric you glance at. It is a direct competitor to equities, especially those high multiple growth stocks. It's the cost of risk-free money.
Correct. When you can get a guaranteed 4.14% return with zero risk, The premium you're willing to pay for those aggressive future-dated growth projections in tech and AI, it narrows significantly. That yield is eating the alpha premium. It sets a hard valuation ceiling for the entire NASDAQ.
Okay, so with that structural headwind in mind, let's define the lines in the sand for the S&P 500 futures, the ES. We're fighting hard for that psychological 7,000 handle, but we're seeing clear rejection from Friday's 6,945 intraday high. The market just looks legitimately exhausted up here.
That 7,000 mark is the ultimate psychological and structural cap for 2025. That is the line in the sand for resistance. Breaking it would require a paradigm shift or just a sudden flood of unexpected capital.
Not likely today.
Not likely. More critical for today is the floor. Support is the non-negotiable, must-hold level at 6,850.
And why is 6,850 the must-hold floor?
Because if we breach 6,850, we risk what traders call a trapdoor move.
Right.
That means selling pressure accelerates rapidly on stop-loss triggers, plunging us quickly back toward the 50-day moving average, which is sitting way down at 6,780. The intraday pivot for bears to take control is 6,921.
Okay, pivoting to the NASDAQ 100, the NQ. The index most sensitive to that 4.14% yield. Tech is oscillating in a high compression zone, and you can almost feel the AI fatigue.
Yeah, you can. Resistance on the NQ is the heavy supply zone at 26,000. To break that requires a massive coordinated bull effort, which, given the data vacuum, we are highly unlikely to see.
And support.
The structural floor is 25,000. If that breaches, it invalidates the entire December bullish structure, and we start targeting 24,600. The immediate operational pivot is the 50-day EMA at 25,130. If we can't reclaim that on the implied open, you should expect a slow bleed toward that 25K floor.
So let's sum this up. We have thin volume, structural headwinds from the 10-year yield, and just clear exhaustion at the highs. This sounds like a liquidity trap.
The verdict is unequivocally a liquidity trap. And for our listeners, a liquidity trap is where participation falls so low, we're talking 50% below the 20-session average, that market makers can hunt stops almost effortlessly.
So they just push prices slightly above resistance or below support?
Triggering massive orders on minimal volume, only to reverse the price immediately. It's stop hunting, but it's disguised as trend continuation.
And this is where it gets tactical for you. The specific trap levels. Moves above 6,950 on the ES or 25,700 on the NQ are highly likely to be bull traps. They're designed to lure in that late-stage FOMO money before the market fades back into the range.
So the strategic directive has to be, do not chase the first 30 minutes of price action. This is a range-bound environment until those key structural caps, 7,000 or 26,000, are taken out with substantial real volume. Until then, you trade the range defensively.
Okay, moving to sector strategy. Let's talk about mandated buying, the strategy behind the volume we are actually seeing. We're talking window dressing and rotation plays. The lead sector analysis points straight to cybersecurity, CIBR, and HACK. Why cybersecurity specifically?
This is pure institutional budget flush. So think of a CIO at a major corporation. They have 72 hours left to spend their remaining 2025 IT allocation.
If they don't spend it, they lose it.
They lose it, and their 2026 budget gets cut. So they need high-margin, defensive, easy-to-justify software purchases. Cybersecurity fits that profile perfectly.
So this is defensive growth positioning. It's a rotation out of those overextended capital-intensive semis we talked about and into high-margin SaaS security plays. A quick, defensible way to spend down remaining capital.
Exactly. And let's look at 3 high-volume stocks benefiting from this.
Let's get.
First, Palantir, PLTR. Heavy pre-market volume on a rumored Tier 1 defense contract renewal. If that contract renewal is confirmed and the stock breaks above $60, we could trigger a gamma squeeze.
Let's clarify for the listener, what is a gamma squeeze in plain terms?
It's a forced buying event. So if the stock passes a critical price point, in this case, $60 dealers who sold options contracts are suddenly forced to buy the underlying stock to hedge their position.
And that creates a massive self-feeding cycle of buying pressure.
A feedback loop. The bull case targets $62.50 on that squeeze.
But if the news turns into a classic sell the news event, the bear case is a flush down to the 20-day moving average at $56.
Right.
Then we have the ultimate window dressing candidate, NVDA.
Absolutely. I mean, think of window dressing as portfolio cosmetic surgery.
Yeah.
Fund managers need NVDA on their year-end top holdings report. It just makes their performance look pristine for clients.
So they're buying the dip in this low-volume environment simply to clean up the appearance of their portfolios.
That's all it is. The bull case targets retesting that psychological $150 level, purely driven by this institutional buying pressure. It could push to $152.
Conversely, though, failure to hold $140 would suggest managers are actually trimming gains to lock in performance bonuses rather than dressing up the portfolio.
That is the critical distinction.
And if they trim, the bear target is $138.50.
Finally, Tesla, TSLA. High relative volume that's front-running tomorrow's anticipated Q4 delivery estimates. The stock is volatile because the delivery numbers are still, unconfirmed. Positive whispers could ignite a rally toward $318.
But if they disappoint, look for that stock to drop rapidly below the $300 retail floor. That retail support is surprisingly strong, but once it's broken, the risk is a plunge down to $292, which would signal a rough structural start to 2026 for the stock.
Now, we need to tie these tactical stock plays back to the broader picture. The 10-year yield at 4.14% is the headwind, but we also had the dollar index, DXY, hovering near 98.00, finding a technical floor in this thin liquidity.
And this raises the single most important question for today. Where is the institutional money actually rotating? Retail is aggressively buying the tech dip, confusing this window dressing for genuine structural buying. What's the institutional pain trade that retail is missing?
The pain trade is staying overweight in paper assets, meaning tech and growth, while institutional big money is quietly, methodically, rotating into hard assets. They are hedging against anticipated 2026 fiscal uncertainty by piling into gold, currently at record highs near $4,500, and silver.
So the trap is seeing NVDA at $145 and thinking it's cheap just because it was $155 last week.
Right.
The reality is that institutions are using this low-volume environment to exit paper assets, even successful ones, and enter what we call the commodity control trade.
They're preparing not for a growth miracle next year, but for a new inflationary structure, likely driven by government spending.
So if the 10-year yield is the anchor, we watch the 4% level.
Correct. If it holds, tech stays structurally in the freezer, regardless of how aggressively fund managers are buying Nvidia for their year-end reports.
So what does this all mean for you today? You have to stay nimble. Institutions are currently painting the tape for their clients, but the underlying macro structure is fundamentally defensive. Don't fight the trend if volume confirms a move through 7,000, but absolutely do not chase the low-volume breakout.
It is a trap. It's meant to clean out weak hands.
And here's a final thought for you to mull over. We opened with geopolitical stability, the Ukraine peace negotiations, cooling that risk-off sentiment. If that geopolitical calm holds, does the institutional rotation into gold at a record $4,500 signal a fear not of immediate conflict, but of future 2026 inflation and massive fiscal uncertainty? Trade the levels, not the headlines. Stay nimble.